In 1873, the world's richest economy collapsed in 47 days, and nobody saw it coming. The crash started not with a bang, but with a single railroad company going bankrupt on a Thursday in September. J. Cook & Company, the most trusted financier in America, locked its doors. Cook had poured billions into Northern Pacific Railroad, betting the entire nation's future on iron rails stretching west. When investors realized the railroad would never turn a profit, they panicked. Banks that had loaned Cook money suddenly faced ruin. Within days, the panic spread from Philadelphia to New York, then across the Atlantic to London and Berlin. But here's the puzzle: why did one company's failure topple the entire global economy? The answer lies in a railroad bubble that had been inflating for 20 years. After the Civil War ended in 1865, America's railroad network exploded. Every major city wanted tracks. Every investor wanted shares. Railroad companies promised fortunes, and for a while it worked. Stock prices soared. New lines opened monthly. The problem: most railroads weren't actually profitable. They were built on hype and cheap credit. What kept the bubble inflating? European money. German, British, and French investors had enormous capital after their own industrial booms. They looked across the Atlantic and saw railroads as the future. So they bought American railroad bonds, basically IOUs promising steady returns. Banks and wealthy speculators also bought these bonds, then used them as collateral to borrow even more money to buy more bonds. It was a chain of debt stacked so high that nobody bothered asking, what if the railroads fail? In 1870, Germany did something that shattered confidence. After defeating France in the Franco-Prussian War, Germany demanded 5 billion francs in gold as reparations. France paid it, but this massive transfer of gold from Paris to Berlin destabilized European currency markets. Gold, remember, was the backbone of every nation's money supply. When gold flowed out of Britain and France, their banks had less gold backing their loans. European investors got nervous. They started selling their American railroad bonds to raise cash back home. This created a vicious circle. As European investors sold American railroad bonds, prices fell. American banks and speculators who'd bought those same bonds at higher prices now faced losses. To cover their losses, they sold other assets. Stock prices collapsed, credit dried up, business owners couldn't borrow money to pay workers. Workers got laid off, stores closed. The panic became self-fulfilling, fear itself became the commodity being traded. By October 1873, the full scale of the collapse was visible. The New York Stock Exchange had lost over 20% of its value. More than 5,000 businesses failed. Unemployment hit levels not seen since the Civil War. In Britain, the Bank of England raised interest rates to protect its gold reserves, which made credit even more expensive and panic worse. The crisis jumped from New York to London to Berlin to Vienna. It was genuinely global, the first worldwide financial panic of the industrial age. The depression that followed lasted 6 years, not a recession, a genuine depression. Prices fell by nearly 30%, wages collapsed, farmers couldn't sell crops, miners worked for pennies. The working class faced the worst poverty since industrialization began. Strikes erupted across America and Europe. Governments had no safety net, no unemployment insurance, no welfare. People simply starved or survived on charity. But why did it take 6 years to recover? Because nobody understood what had happened. Economists blamed overproduction. Politicians blamed foreign competition. Bankers blamed the government. Nobody connected the dots. The bubble had been built on borrowed money for unprofitable railroads, and when European confidence collapsed, the entire structure came down. Without understanding the cause, policymakers couldn't fix it. They just waited for the economy to heal itself, which it eventually did slowly. Here's what makes this history relevant. The 1873 panic was the first crisis where global supply chains and international capital flows created a single, interconnected economic system. When one piece failed, everything failed. The railroad bubble wasn't just American, it was European money chasing American assets. When that money fled, it triggered cascading failures everywhere. That interconnectedness is the world we still live in today. So why did railroads cost what they did? Because investors believed in a future that didn't exist yet, and they were willing to pay for it on credit. That optimism created a bubble. The bubble required constant growth to stay inflated. When growth stopped, the whole structure collapsed. And because the world's money supply was now woven together through bonds and gold flows, one nation's panic became everyone's crisis. That's the lesson. Bubbles aren't about the asset itself. They're about the stories we tell ourselves about the future, and what we're willing to borrow against to chase it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how the hidden machinery of money, supply chains, and global economics shapes what you pay for everything, subscribe. There's a new story like this one every week. Subscribe, there's a new story about the hidden forces behind prices and systems every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.